Hello and thanks for watching the video. I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. In this short video, I'm going to give you a brief update on our 9 months 2023 results. With our 9 months results, we addressed 3 key topics which I will touch upon in this short video. First, we offered strong operational numbers. This puts us well on track to reach the upper end of our guidance. Secondly, we provided markets with an update on our refinancing strategy, and to put it short, we are refinanced until mid-2025. And thirdly, we introduced our 2024 guidance, where we see a further increase in AFFO of around 10%. So on our 9 months results, they continued on strong operational numbers. We continued to benefit from the strong dynamics in the German housing market, which is characterized by a strong supply-demand imbalance and a high demand for rental apartments, especially in the affordable segment, where we are exclusively positioned. We were able to increase our rents on a like-for-like basis by a strong 4.0%, and on a reported basis, net cold rent grew even stronger by 4.5%, as growth from new build units more than offset the effect from disposals. Vacancy rate came also further down by 20 basis points to 2.4%. Effectively, we are fully rent out. Because of our new steering approach, cash generation increased strongly, and we achieved an AFFO, which is our key figure, of 176.9 million euros. This represents an increase of more than 50%. Operating cash flow also increased by more than 18%. Like in H1, the 9 months figures also benefited from the forward sale of the 2023 electricity production of our biomass power plant. Here we were able to benefit from the high energy prices in 2022. Additionally, the AFFO is also driven by a substantial cutback of our capex spendings, which we brought down by 23% for the investments into our standing portfolio, and which also benefited from further cutting down on our new development projects. As always, the last quarter will be impacted by a higher level of capex spending, and this is why, as the investments will be fully funded by the cash generated in Q4, we expect to keep at least the current AFFO level. With this, we specified our AFFO guidance for 2023 towards the upper end of our 165 to 180 million euro range. Additionally, we provided markets also with a valuation outlook for the second half of 2023. We expect valuation to come further down by another 4 to 6%, which suggests also a slowdown in downward pressure. We would expect more pressure to unfold in lower yielding market segments. Overall, our portfolio offers now already a gross yield of 4.6% as of today. If we take those additional devaluations into account and further rent increases, which we guided for as well, this will put our gross yield towards the 5% level, i.e., we offer already a yield spread over the 10-year bond of almost 240 basis points by the time of this recording. And let me now move to the financing of our business, where we made significant progress within the last quarter. As you see on the left side, we have no maturities left for 2024. We already paid back a 500 million bond, which was set to mature in January 2024, and we could already refinance the maturing secured financings. This leaves us fully refinanced until mid-2025, when secured financings will mature, and we expect them to be rolled over. And the next major maturity is then only a convertible bond, which is due in September 2025. i.e., by the time of this recording in November 2023, we still have almost 2 years until to refinance a major capital market bond. As a result of our refinancings, but also of our strong standing financings, we have now an average maturity on our financial liabilities of 6.6 years at a still attractive interest rate cost of 1.65% on average. Thus, our average interest rate costs, they are only rising slowly and they remain clearly manageable. This comes on top of a strong liquidity position. At the end of September, we had a cash position of 326 million euros. This includes also short-term deposits, as well as an unused total revolving credit facility of 675 million euros. Our LTV at September 30th increased to 46.8% from 43.9% as at year-end 2022. This was driven mainly by the devaluation effects in our property portfolio, which we did in H1, and where we saw a devaluation of 7.4%. And as I said earlier, we expect another 4 to 6% for the second half of 2023. We have now set a new medium-term target level for the LTV to better reflect the changed market environment, but also in order to align it with Moody's rating and its methodology. It has been set at a medium-term target level of 45%. Our cash-focused steering approach will certainly help us to reduce the LTV number. So would disposals. And we made some progress there by selling around 1,600 units, as well as commercial units for a total of 130 million euros. All of those have been sold at book value, and we will continue our disciplined approach to not pass shareholder value to third parties by selling either at discounts or engaging in structured bigger deals. And with this, let me now recap with where we stand and what we aim for. Without any doubt, times remain challenging and there are parameters which we have in our hands, but unfortunately, there are others which are beyond our influence. And for the latter part, we all witnessed an historic increase in interest rates, which dried out the transaction markets completely, as it put a high burden on financings. Therefore, we pulled all levers to adapt the organization as quickly as possible to a higher for longer interest rate environment. We kicked off our Cash is King strategy already last November 2022, when we presented the market for the first time our new cash steering approach. Operationally, our focus was on delivering on rent increases, and we will continue to execute on this accordingly in 2024. This year, in 2023, we benefited from the cost rent adjustments for our subsidized units, with 80 basis points out of the 4.0% which are reached in the first 9 months. So adjusted for this, the underlying rent growth in 2023 will be around 3.0 and 3.2%, which is what you see on the slides. For 2024, we expect underlying rent to grow again and gain some momentum. And we expect a like-for-like rent growth of 3.2 to 3.4%, and this represents an additional 20 basis points of rent growth. We will keep costs under strict control, therefore, and despite a still quite substantial inflation rate, we expect only a moderate cost development. On the investment side, we continue to bring down our spendings on a square meter basis to 32 euros. This translates into a saving of another 9% in nominal terms, and certainly into a double-digit saving in real terms. To make that ambitious target work, we will make use also of the subsidization regime. And as I mentioned earlier, due to successful refinancings in 2023, we face the next maturities mid of 2025. This provides us now with a substantial freedom to further optimize our debt book going forward. With all those measures, we continue to strengthen cash generation. All of that translates into a guidance for the AFFO to increase by another 10%, comparing midpoints of both guidances. Again, this is a cash-driven figure. LEG is unique in this respect within the segment. We do not steer our business based on a much more accounting-driven KPI FFO1 anymore, as we believe in this environment of high interest rates, having a focus on cash, AFFO is the best KPI to adapt to. And this puts us well on track for our full year 2024 guidance to reach an AFFO of 180 to 200 million euros. There will be also an effect on the EBITDA margin, which you see we expect to be at around 77%. This represents a decline over the 2023 guidance of around 80%. This effect, however, is not operational. It's fully driven by the one-off contribution of our biomass power plant. As I said, we were able to sail forward our electricity production 2023 at peak prices. This effect will, however, not be repeated in 2024, which is why you will have this decline in the EBITDA margin. On the other hand, apart from the financial targets, we continue to provide markets with an explicit ESG target. ESG remains important to us. We just got our decarbonization targets approved by SBTi, which gives us, and should you as well, give the confidence that we are serious about our CO2 ambitions and innovations powered by LEG. And they will continue to play an even bigger role in the focus as we optimize the CO2 yield spent per euro. And this should allow us going forward to further work on the investments while continuing on our decarbonization path. And with this, I come to the end of the video, and I hope I gave you a good overview of our 9 months 2023 results. Should you have any questions, then please do not hesitate and contact me or the team, and we are happy to answer your questions. Thank you and goodbye.